Recently, I presented at the annual conference in Poland on behalf of CFA Society Poland. It was a fun experience. There were quite a few speakers, but only two speakers from outside of Poland. They had a public equity speaker, Aswath Damodaran from NYU, and they had a private equity speaker, me, where I spoke about how to improve investment decisions in private equity in 2021. Anyway, I thought that I would recreate that speech for you here with our graphics. I hope you like it. Now, before we get started, let's remember the different methods of investing in private equity. There's fund investing. This is for investors that don't want to buy companies themselves and are okay paying the management fees and performance fees associated with hiring a professional to do it for them. There's direct investing. This is for investors that have the expertise to find, buy, create value in, and sell private companies on their own. There's co-investing. This is for investors that invest in private equity funds, but also want to access direct deals, whether it's to reduce fees or eventually to build direct investing capabilities. There's secondary investing. This is for investors that are looking to mitigate the J-curve. In other words, because private equity funds usually have a 10-year life, secondary investing helps reduce the time frame of the illiquidity. There's fund of funds investing. This is for investors that may be new to private equity and can gain access to multiple geographies, sectors, and vintages through a fund of funds. And they don't mind paying the fees associated with fund of funds. There's public private equity firm investing. In other words, buying publicly traded shares of private equity firms. In my opinion, this is for investors that want to tell their friends that they're investing in private equity, but are really buying stocks in the financial services sector of their public portfolio. I'd argue that this doesn't count as investing in private equity, but some may disagree. And finally, there's investing through intermediaries. In other words, investors that look to their wealth management firms and financial advisors to invest in private equity on their behalf through fund investing, direct investing, co-investing, secondary investing, and fund of funds investing. Today, we will talk about improving decisions in private equity in terms of direct investing. More specifically, we will go over three main tips when you are looking to buy companies in 2021. They are tip number one, look for creative ways to work with existing companies that have changing strategies in the current environment. Tip number two, look to work with family-owned companies that need to meet the new demands caused by COVID-19 pandemic. And tip number three, with the emergence of private debt, explore your options for financing private equity investments. And also, we have a bonus tip at the end of this talk. So let's get started with tip number one. Look for creative ways to work with existing companies that have changing strategies in the current environment. To further explain this tip, I'll give you an example of the recent Tropicana deal, where PAI Partners, private equity firm based in France, bought Tropicana, the famous orange juice brand, from PepsiCo. To give you a little background, back in 1998, Seagram sold Tropicana to PepsiCo, or Pepsi, for $3.3 billion, which was Pepsi's largest acquisition up to that time. Pepsi had been competing with Coca-Cola, or Coke, for years in the cola market. Coke owned and still owns Minute Maid orange juice, so with the purchase of Tropicana, Pepsi would be competing with Coke in the refrigerated orange juice market. Coke would bring the competition to new levels when in 2001, Coke, actually through Minute Maid, launched Simply Orange to compete in the refrigerated orange juice market. For the next 20 years, PepsiCo with Tropicana and Coke with Minute Maid, including Simply Orange, have been competing in the refrigerated orange juice market. And last month, in August 2021, PepsiCo made a deal to sell Tropicana to PAI partners. Well, technically, it wasn't an outright sale. In fact, PepsiCo will net $3.3 billion in after-tax proceeds from the deal, and also will retain a 39% stake in the newly formed joint venture with PAI partners. And PepsiCo will have exclusive US distribution rights. So PepsiCo will be able to generate some cash up front from the asset and still retain some of the upside through the joint venture. Now, this is interesting since PepsiCo has recently been an acquirer. In 2018, PepsiCo acquired SodaStream for $3.2 billion. And in 2020, PepsiCo acquired Rockstar for $3.85 billion. But in this deal, PepsiCo was a seller. The company sold Tropicana, Naked, and other juice brands to PAI partners. Now, consumer trends have been moving away from sugary drinks such as Tropicana. With this transaction, PepsiCo will be able to use the capital for its products that are growing quickly, such as healthier snacks, zero-calorie beverages, and the company's SodaStream business. Also to note, PepsiCo will be able to use some of the capital to pay down its debt. So PepsiCo is able to gain cash from this deal to use in other growing categories and to pay down debt while it will still retain some of the upside for Tropicana in the joint venture with PAI partners. Now, PAI partners focuses on multiple sectors, including food and consumer. More specifically, PAI has experience from a joint venture they have with Nestle in the ice cream business. PAI was able to provide PepsiCo with the confidence needed for PepsiCo to retain a 39% stake in the Tropicana deal, even though PepsiCo's longer-term focus is away from sugary drinks. So, let's put this all together to conclude our first tip. Investors, when looking for opportunities in private equity in the current changing global landscape, you probably want to look beyond standalone companies. There may be an opportunity to look at a division of a company that doesn't align with the company's future goals. While some of these companies, such as Pepsi, may be too large for certain investors, other smaller companies may experience the same thing. As companies face changing global conditions in 2021, their priorities may change. And this could be an exceptional opportunity for investors to purchase a division of a company, or even to come up with a unique structure such as the Pepsi PAI joint venture. And this can help unlock value for both the buyer and the seller. So investors, remember, tip number 1, look for creative ways to work with existing companies that have changing strategies in the current environment. Now, let's move on to tip number 2. Look to work with family-owned companies that need to meet the new demands caused by the COVID-19 pandemic. To further explain this, I'll give you an example of the recent Medline deal, where multiple private equity firms, including Blackstone, invested in Medline, a large healthcare company in the US. To give you a little background, Medline is a family-run company that manufactures and distributes healthcare supplies, such as masks, surgical gowns, and sanitation products. The company is led by the Mills family and had $17.5 billion in sales last year. Throughout its life, Medline has prided itself on fantastic customer service and on having very little debt. You may know Medline from CEO Charlie Mills's brief talk at the White House in March 29, 2020, when Charlie said that Medline had ramped up production to 100,000 masks per day to help with the COVID-19 pandemic, right when the pandemic started to spread to the US. Earlier this year, 3 large private equity firms, Blackstone, the Carlyle Group, and Hellman Friedman, along with GIC, Singapore's sovereign wealth fund, purchased Medline in a deal that reportedly values the company at over $30 billion, including about 50% debt. The Medline family plans to continue to run the company and will reportedly collectively own 25% of the company. In this deal, Medline plans to grow revenue by using the capital to create new products and expand internationally at a faster pace. And Medline plans to cut costs by using the capital to invest in global supply chain improvements to Medline's current supply chain infrastructure. Now, Medline probably faced unique capital outlays caused by the rising demand for its products during the COVID-19 pandemic. The Mills family publicly prided themselves on taking on very little debt in the past, but situations clearly changed, which caused the family to accept a private equity investment and agree to take on debt in the company. It'll be interesting to see how COVID-19 has affected the desire for other family-owned companies to accept outside capital and put debt on their companies. So investors, remember, tip number 2, look to work with family-owned companies that need to meet the new demands caused by the COVID-19 pandemic. Now, let's move on to tip number 3. With the emergence of private debt, explore your options for financing private equity investments. To further explain this tip, I'll give you an example of the recent Stamps.com deal where Thoma Bravo bought Stamps.com for almost $7 billion. To give you a little background, Stamps.com offers software through a subscription to help small businesses, online retailers, and other customers purchase and print stamps on any printer. Stamps.com offers many integrations with online marketplaces such as Amazon and online stores such as Shopify. In short, Stamps.com makes shipping easier for its customers. The company has grown rapidly since it started in 1996 through partnerships with companies such as the US Postal Service and through strategic acquisitions of companies such as ShipStation and ShipWorks. Stamps.com went public in 1999, and as of July 2021, Stamps.com had nearly 732,000 monthly subscribers. Well, on July 9th, 2021, Thoma Bravo, the large software and technology-focused private equity firm, entered into an agreement to acquire Stamps.com for $6.6 billion, which at a price of $330 per share is 67% higher than the closing price the day before on July 8th, 2021. If this transaction goes through, Stamps.com will become a private company. For the Thoma Bravo Stamps.com deal, it was announced that the debt financing for the transaction will be provided by Blackstone Credit, Ares Management, PSP Investments Credit, and Thoma Bravo Credit. Did you notice something unusual about this? Well, the main debt providers are not banks. While it was announced that JP Morgan advised on the deal, the debt financing was offered by two big private debt providers in Blackstone Credit and Ares Management, one private debt arm of a big Canadian pension, PSP Investments Credit, and the private debt arm of Thoma Bravo itself, Thoma Bravo Credit. There has been quite a lot of growth of private debt in the market in recent years. While this deal is an excellent example of how large private equity firms such as Blackstone are more active in the private debt space, there are quite a few new players in private debt in all deal sizes. So investors, remember, tip number 3, with the emergence of private debt, explore your options for financing private equity investments. Now, before I leave you, I'd like to give you a bonus tip. Investors, just like all asset classes, private equity has its ups and downs. Right now in 2021, debt is cheap, multiples are high, and deals are plentiful. With that said, nothing lasts forever. One of the most important things to remember when investing in private equity is that private equity is only part of your entire portfolio. If you're looking to alter your private equity strategy in 2021, make sure that the strategy takes into account the strategy of your entire portfolio. If you're going to buy companies using creative structures, such as the Tropicana deal, and family-owned companies looking for cash, such as the Medline deal, or using private debt, such as in the stamps.com deal, please make sure that your private equity strategy makes sense when you look at the risk-return characteristic of your entire portfolio. So that's my advice on how to improve your investment decisions in private equity in 2021. Pretty straightforward. Tip number 1, look for creative ways to work with existing companies that have changing strategies in the current environment. Tip number 2, look to work with family-owned companies that need to meet the new demands caused by the COVID-19 pandemic. And tip number 3, with the emergence of private debt, explore your options for financing private equity investments. And we gave you a bonus tip, which is not just for 2021, but for every year. Make sure that your private equity strategy makes sense when you look at the risk and return characteristics of your entire portfolio.